Hey everyone, Hyundai Motor Group, a South Korea-based auto company and world's third largest auto manufacturer in passenger vehicle segment, is launching the IPO of its Indian subsidiary, Hyundai Motor India Limited. This is the largest IPO in the history of India with an IPO size of 27,850 crore. Before this, LIC held the record of largest IPO at 21,000 crore. With this IPO at an upper price band, Hyundai Motor India would be listed at a market cap of 1.6 lakh crore. Now, Hyundai Motor needs no introduction. It has been a household name in India with a brilliant portfolio of passenger cars across categories like sedan, hatchback, SUV, and they have also entered into the Indian EV segment. Company's leadership in the Indian market can be gauged from the fact that it enjoys a 15% market share of 4.2 million passenger vehicles sold in India in fiscal year 2024. So in this video, we'll discuss the business model of Hyundai Motor India along with its key strength, financials and future growth potential. And then we'll cover the IPO details. We'll also cover why Hyundai has launched a complete OFS, that is offer for sale. Here please note that this video is not to make any quick money from IPO. That decision is anyway based on the grey market premium. And Hyundai's grey market premium has crashed badly. My main goal here is to discuss whether Hyundai Motor India has the potential to become a part of long-term investment portfolio or not. I believe that Hyundai Motor India has got everything required to be a portfolio grade company. The only question is, what is the right valuation to buy this company? And finally, we'll discuss the key risk in the growth thesis before giving a verdict on whether it is worth investing in the company for long term or not. Alright, let's get started. To begin with, Hyundai Motor India is the second largest OEM in the country after Maruti with 15% market share of Indian passenger vehicle segment based on its sale in calendar year 2023. Not only that, it is the largest auto OEM in India in the mid-size SUV segment by sales volume. The Creta has a market share of 38% in mid-size SUV sub-segment as of Q1 of 2024. If you recall, I did a recent video on premiumization trend in India where I covered a few auto stocks that are riding the trend of shift in preference from hatchback and sedan segment to SUV segment. That's where Hyundai is very well positioned to benefit from premiumization trend in India, and I would like to add it in that premiumization list. In fact, Hyundai Motor India has its presence across car segment. Within hatchback, it includes Grand i10, i20. Within sedan, it includes Verna and Aura. Then SUV include your Exter, Venue, Creta. Then N-Line, which is the sport version of Creta and Venue. Then they have Alcazar and Tucson. They also have launched their first premium EV car in India, Ioniq 5. They also have presence across powertrain segment that include your petrol, turbo petrol, diesel, CNG and electric. And they are planning to launch hybrid engine by FY26. So their strong presence across the spectrum of passenger car segment and powertrain segment along with leadership in mid-size SUV with brand Hyundai that they've built over the last 25 years in India is one of their biggest strengths. The next very important aspect to understand is, since Hyundai Motor India parent company is in Korea, how does the manufacturing ecosystem work for Hyundai Motor India? So first of all, Hyundai has a centralized R&D hub in Korea that takes care of all technology innovation. Hyundai has invested a total of $24.6 billion in global R&D between 2014 to 23 towards your emerging mobility area like electrification, autonomous driving and shared mobility. Apart from R&D, Hyundai Motor India also gets support from its parent company across areas like quality management, top manufacturing practices, product design, product planning and so on. But as far as manufacturing is concerned, Hyundai Motor India has a manufacturing plant in Chennai with production capacity of 8.24 lakh unit as of FY24. Company has planned to expand this manufacturing capacity to 10 lakh unit by FY26. Not only that, Hyundai Motor India has an entire local auto component supplier ecosystem where 90% of their parts are sourced from India. I hope you got a fair idea of Hyundai Motor business segment and its key strength. Now let us look at the future growth drivers and Hyundai India growth plan. Now as far as future is concerned, car is a dream of every person in India. And data suggests that we still have only 33 passenger cars per 1,000 people in India. In comparison, developed countries like US have 860 cars per 1,000 people. Just look at the massive gap. Even China has 223 cars per 1,000 people. And look at where India is. But with rising income and spending level, the passenger car market in India is growing at a very fast rate. On top of that, the biggest growth driver in the passenger car market of India is the premiumization trend, where people are now preferring SUV cars. And that's where Hyundai is in a sweet spot with its leadership in the mid SUV segment. For me, this is one of the biggest reasons why Hyundai Motor would continue to do well in India. The next biggest trend in the auto industry is technological advancement. 21st century is all about electric, connected, autonomous and shared mobility. Today, the majority of R&D expenses of auto companies are into these 4 mega trends. So going forward, companies that would excel in these 4 mega trends would continue to lead the market. That's where Hyundai is also focused on. Today, Hyundai cars are loaded with top features in the segment, and they are continuously upgrading their cars with new technology. Yes, there's one issue where currently their cars don't have NCAP 5-star safety rating, but the features they offer in the category, along with their trusted engine, makes them one of the most preferred car in the segment. In fact, last year their Made in India Verna new model has got 5-star safety rating. Now if you ask me, currently there is one gap where Hyundai has not yet excelled the EV car market in India. Having said this, they have big plans to launch EV vehicle in India, including Creta EV version in Q4 of FY25. I believe that Hyundai Motor global expertise in EV segment would help them gain market share in India as well. But of course, price point would also play an important role in Indian market. To minimize the pricing for EV cars, Hyundai Motor India is focused on securing local production capability for key parts such as your cells, battery pack, power electronics, drivetrain, and building a localized EV supply chain. By the way, Hyundai Motor India is also the largest exporter of passenger car from India. So they not only manufacture for India, but also for the world. And as of June 24 data, around 76% revenue of the company is derived from domestic market, while export account for around 24% share. On top of that, company is investing heavily in brand building and also expanding the distribution network in tier 2 and 3 cities. I think that all these initiatives would help the company in their future growth plan. Now let us look at the IPO details and financials. So Hyundai Motor IPO window is between 15 to 17th October with price band in the range of 1865 to 1960 rupee. Minimum investment is 13,720 rupee. That would fetch you 7 shares of the company. Now this IPO is complete OFS worth rupees 27,860 crore, where the entire proceed of the IPO would go to its parent company, that is Hyundai Motor Group. Now a lot of people have raised concern about the OFS, but I've always mentioned that not all OFS are bad. At the end of the day, you need to understand why a company launches the IPO. One of the primary reasons is to raise money from the market. But what if the company already has enough capital for growth? In that case, it can still go for the IPO because listed companies are more regulated and transparent. But they don't necessarily need to raise capital for IPO. For instance, in case of Hyundai Motor India, they have made a profit of 6,060 crore in FY24. And was sitting on cash and cash equivalent worth 17,741 crore in FY23. Although it paid a hefty dividend worth 10,780 crore to its parent company in FY24. Hence, its current cash and cash equivalent got reduced to 9,070 crore in FY24. Still, that's a lot of cash in hand, and that is the reason they don't need to raise capital. Now, let us look at the financials and valuations. So this slide gives an idea of Hyundai Motor India financials. If you look at the net sales, it has grown from 40,972 crore in FY21 all the way to 69,829 crore in FY24 at a very impressive 19.4% CAGR. EBITDA has grown from 4,245 crore in 21 to 9,132 crore at an exceptional 29.1% CAGR rate. Net profits have grown from 1881 crore all the way to 6,060 crore at 47.7% CAGR rate. Now, one of the reasons has been because economy opened up post-COVID in FY21 and there was an exceptional rally in the Indian passenger vehicle sector in the last 2-3 years. Going forward, it would be interesting to see if it can maintain this kind of growth or not. Then if you look at the return on net worth, it has again improved from 12.3% all the way to 56.8%. Return on capital has improved from 13% all the way to 17, 24 and now 55%. So very impressive data on return on net worth, return on capital, and P ratio is around 26.3. I was also looking at the comparison of net asset turnover of Hyundai versus Maruti, where Hyundai India has a net asset turnover of 10 times versus Maruti net asset turnover of 8 times. So efficiency wise, Hyundai has better efficiency as compared to Maruti. So at an upper price band of 1960, Hyundai Motor would command a market cap of 1.6 lakh crore rupees, and based on its FY24 earnings, its P ratio would be in the range of 26 to 27. The biggest question here is it worth paying this P to Hyundai Motor India or not? That's where I've done a comparative analysis with Maruti Suzuki that also command a P in the range of 27. So overall Hyundai valuation is at par with Maruti, which is reasonable. Having said this, at P of 27, the issue is fully priced for the near term. It's neither too cheap nor too expensive. Now let us look at the final part, that is key risk in the growth thesis. So first key risk is cannibalization risk. While Hyundai Motor has got undisputed leadership in mid SUV segment, there's another company, Kia Motor, which is also the subsidiary of Hyundai Motor Group, and Kia is giving tough competition to Hyundai. So there's a risk of cannibalization where potential customer of Hyundai India can shift to Kia. Second risk is cyclicity risk. Although there is a structural long-term demand for car industry in India, in the short term, there is volatility in demand. Now in the last 2-3 years, it has been a wonderful journey for passenger car industry in India, but of late, there are concerns over slowdown in demand and inventory piling up. And that's where companies have the pressure to offer discount to clear out the inventory, and that impact the profitability. So this volatility in demand in the short term would pose cyclicity risk for the auto industry. Third risk is technology risk. Auto sector is evolving at a fast pace with launch of multiple powertrains including electric vehicle, hybrid vehicle and latest technologies. So Hyundai Motor has to ensure that it consistently evolve with changing customer preferences, and any failure to innovate in terms of technology could badly impact company's business. Then fourth risk is royalty payment risk. Please note that Hyundai Motor India has an agreement with its parent company where it pays 3.5% of revenue as royalty fee. But in future, if this royalty fee increases, it can negatively impact Hyundai Motor India profitability. Then fifth risk is competition risk. Indian auto industry is highly competitive with domestic companies like Maruti, Tata Motor, Mahindra and Mahindra, and then you've got global players like Kia, Volkswagen, Honda, MG Hector, Skoda, Renault that are direct competitor to Hyundai. So competition risk would always exist. And then final sixth risk is IPO liquidity risk. Historically, it is observed that large IPOs have struggled to do well. For instance, LIC share price fell down after listing. Then Paytm has seen massive wealth erosion. Although we can't directly compare it with Hyundai because Hyundai is into a different sector altogether, but there's always some level of liquidity risk with huge IPOs. Now let us look at the conclusion and take a call whether it is worth investing in Hyundai or not. Overall, Hyundai Motor India is a fundamentally super strong company, and I look at it as a portfolio grade stock. Yes, you can't expect the share price to generate massive return on listing or share price to double in next 1 to 2 years. But this can be a consistent compounder for many years. Now the question is it worth applying for the IPO or you can wait for the listing? So in my opinion, there's no need to hurry. You can wait for the listing as well. Considering the grey market response, I don't expect Hyundai to list at a high premium. In fact, there are even chances of flat listing or some discount on listing. So I believe that at a PE of 26-27, Hyundai Motor India is reasonably priced for long term. Having said this, if there's a 10-20% discount on the IPO price, I would love to consider it in my long-term portfolio. And if you want to closely follow my own investment strategy, you can also explore my weekly video series that include one exclusive video every week where I discuss stocks that I am adding in my own portfolio. I also track more than 200 quarterly results to identify potential investment opportunity. For more detail, you can explore my website or the join button of this YouTube channel. Now tell me in the comment, are you investing in Hyundai IPO or not? If you find this video useful, do share it within your friend circle. I'll see you next video. Till then, take care.